Well, we've been covering a lot of earnings stories, and one of the names from the U.S. we've been tracking today is McDonald's. The restaurant operator took a bit of a financial hit in the latest quarter. Some of that is tied to turmoil in the Middle East. And for more on what's happening with the business, I want to bring in Dunlop. He's an equity analyst at Morningstar. Sean, it's great to have you with us. Going back to the start of the Israel-Hamas war, you would often hear about consumer boycotts in the Middle East against brands such as Starbucks or Coke or, in this case, McDonald's. Now we have a chance to see what's happening with their financials. Can you explain what we know has happened so far?
Yeah, obviously, we saw a number of reports in the interim that suggested something to the effect of declining traffic and consumer boycotts kind of across the region. We saw during the quarter that comparable store sales in the IDL segment, which includes both the Middle East and a number of countries in Asia Pacific and Latin America, increased 70 basis points. And the big data point there is that comp growth was positive in pretty much every country outside the Middle East, which suggests sort of the degree of pressure that they're seeing in that region as that conflict unfolds.
Is there anything that the company has to do as a global brand, the realization that your brand can literally get caught up in politics or war, or is that just something they know is a nature of doing business around the world, and they've been navigating those challenges for decades?
Yeah, I think it's closer to the latter. It's a good question. I mean, we saw something similar with Russia, obviously, in the past couple of years, where it seemed like a completely exogenous event that has these material financial repercussions. It's not that dissimilar here in the Middle East. It's an exogenous event. McDonald's doesn't have a ton of control over it. You can sort of see that as they sort of provided guidance for 2024. They basically admitted the IDL segment and said they'd expect results to turn around once that conflict starts to abate in the region, and that sort of tells you the degree of influence that they sort of expect to have there, which is very limited.
What do you see, on that note, what do you see in this business when you look away from what potentially could be short-term geopolitical challenges?
Yeah, we continue to like it. I mean, elsewhere around the globe, it was a decent quarter. It was probably a little bit slower than we expected, definitely below FactSet consensus. We'd had $6.6 billion in sales, and they put up 6.4. Earnings per share was decent. I mean, I think it's easy to get caught up in the quarter to quarter and the day-to-day noise with the company, but from a long-term perspective, McDonald's is in really good shape. They rolled out in their Investor Day priorities that they are starting to scale their marketing creative. We saw a couple of campaigns like the McDonald's adult Happy Meals and the Monopoly promotions that they rolled out in double-digit markets during the quarter. We're starting to see them really emphasize that core menu IP. They've got 17 different platforms in that core menu that do $1 billion in sales or more. That collectively account for 65% of total system-wide sales. And obviously, you've got streamlining the organization with the global business services that should generate efficiencies over time as you think about certain functions like finance or like legal that are more the same than different across markets, even though that requires a little bit of upfront investment today. And obviously, I think the big story is they're growing as fast as they've ever grown in their history, and it's obviously an illustrious brand, but they're adding 10,000 units between 2023 and 2027, and it didn't seem like there was an appetite to pull back on that, even with some of the headwinds that we're seeing today.
And I'll tell you, when you said adult Happy Meals, that caught my attention. Had not been aware of that, but sounds intriguing. In terms of the growth, how much does technology play into that story? I think people, the in-store experience, you've seen the changes over the last 5 to 10 years, more of these kiosks. How much is technology playing a role in McDonald's ability to grow from here?
Yeah, pretty big role, as it turns out. So there are a couple of pieces that technology really helps with. On the digital ordering side, you'll see things like kiosks, like takeaway windows, like mobile order and payment. Those tend to increase transaction capacity, and that lift can be pretty material. As you look at Chipotle, for instance, when they add the Chipotle lanes, those units have about 10% higher average unit sales than you would see with a conventional box. Similar uplift probably with McDonald's. And then you've got the demand side of the ledger as well. The capacity doesn't mean much if you don't have people wanting to frequent your restaurants. They've got 150 million loyalty program members. And for perspective, you're looking at sort of 3 to 4 for Wendy's, which is the bronze medalist in the U.S. And what that means is that they're able to get those guests to come about 15% more frequently. Those guests tend to spend about 2 times as much at the brand. And that really creates this comp lever where if you look out over the next 5 years, you can see as much as a 1.5 or 2% bump to comp from loyalty program demand alone. So pretty big piece of the narrative.
Okay, so at the end of the day, Sean, I'm looking at your outlook for the investment that is McDonald's, and it looks like you're pretty constructive. You've been recommending these shares, and that seems pretty common on Wall Street, that there's a fair number of buy ratings and a fair number of people who would not be surprised to see these shares steadily move higher over the next 12 months.
Yeah, I think that's the fair approach. You look at this company, and it's got a deep competitive moat. You look at the restaurant industry in general, and it's moving increasingly digital. The largest chains have a massive advantage as you think about investing in things like labor scheduling or predictive analytics for demand forecasting. And the spoils sort of continue to accrue to the large chain restaurants that are able to meet customers where they are and how they want to interact with the brand. So we expect the largest chains with the best unit economics and sort of the best digital chops to continue to gain share over the next 5 and 10 years.
Sean, good to get your perspective.